Taxpayers will see higher standard deductions on their taxes next year.
How to create legitimate itemized deductions that exceed the standard deduction. Get ready. In this episode, I'm going to share with you some strategies where, especially higher income earners, it would be far to their advantage to create itemized deductions that will put them in a lower marginal tax bracket and even effective tax bracket. And I will prove that in this episode and another episode related to this one called What's the Difference Between Marginal and Effective Tax Brackets? And I think you're going to gain insights that maybe you haven't realized before, instead of just taking the standard deduction. You take itemized deductions and you don't just go out and create expenses without making it worth your while, making more than those expenses actually cost. So I'm Doug Andrew, and I've been a financial strategist and actually a tax minimization specialist for 5 decades, helping thousands of Americans prepare for a comfortable retirement. And I help them alleviate unnecessary tax. And I also help many of them go from maybe the highest tax bracket before they met me to even a 0% tax bracket. I discuss these strategies on this channel all the time. In this particular episode, this may seem a little bit tedious, but it's because we're talking about taxes. Please bear with me, because I'm going to put up on the screen here some actual quotes from off of the internet, reliable sources, Forbes, and tax preparation firms that quote out of the Internal Revenue Code. And sometimes they quote and explain it better than the Internal Revenue Code does. And so I'm going to try to keep this as succinct as possible and then connect the dots as I go on why it may behoove you to create legitimate itemized tax deductions. I'll give you a sneak preview. In the related video, the effective versus marginal tax brackets, what's the difference? I actually show a couple making $300,000 a year doing what I'm talking about in this episode. And they are only in an 11.6% effective tax bracket, only a 22% marginal bracket as of the recording of this episode, whereas a single taxpayer making half that is in an effective tax bracket of 16.6% and a marginal bracket of 24%, which would normally be 28, compared to the married couple only being in a 25% marginal bracket. This is a huge difference. There's a lot of simpletons who criticize my videos on this channel when I talk about how to become your own banker and why it's wise to pay interest, tax-deductible interest on a mortgage, and earn compound interest in a instrument like max-funded indexed universal life. And why you end up making double to triple the net cost of the mortgage. You'll actually get out of debt 2.5 years faster. And they go, oh, well, this doesn't apply because most Americans should just take the standard deduction. Oh, really? And that tells me right off the bat, they don't know what they don't know. So get ready, legitimate itemized deductions. So let's understand how this works. When you file a 1040 tax return, you may be aware that you report your gross income, okay? This is on the front page of your 1040 tax return. And then you're able to take some offsets based on, did you contribute money to like an IRA or other, things that are not included as income, and you arrive at AGI. So the AGI is your adjusted gross income. Now, from the adjusted gross income, you can take one of two choices, standard deduction or the itemized deduction route, which is then you itemize deduction on Schedule A of your 1040 tax return. So this is to help you to arrive at what is called your taxable income. That's what you pay tax on, is taxable income. And it's amazing how many people don't understand the difference between the marginal tax bracket, which is the amount of tax, the rate you pay on the last dollars you earned, the last threshold in these tax thresholds and tax brackets, which I go into in the other episode on understanding the difference between marginal and effective tax rates. But you can either reduce that taxable income down by itemizing, but if itemizing doesn't equal what the standard deduction gives you, then just take the standard deduction. So the question is, should I itemize my deductions, or should I take the standard? Well, it's pretty simple. If by itemizing, it's more than the standard deduction, then itemize. Well, I don't want to go through the hassle. No, it's worth it. But I'm going to show you why many Americans who make, middle income to high income earners, it would behoove you to itemize deductions and create the itemized deductions. There's many legitimate ways to do that. Now, I'm going to get into the actual Schedule A. One of the ways that I've helped many of my clients reduce their taxable income is by starting a business. And that's a different tax return. That's Schedule C if you're doing it as a sole proprietorship, just on your 1040 tax return. That's not Schedule E, that's Schedule C. If you have LLCs or corporations, then you file separate tax returns for those. But when you own a business, even a home-based business, there are unbelievable ways that you can tax deduct expenses for that business and reduce the income, because only the net of that business income transfers over to your personal tax return. I have many clients that's a negative, and so it offsets taxes on their personal tax return. Sometimes it takes an extra $100,000 of income because it went through a business entity and there were legitimate business deductions on Schedule C that only maybe 20 or 30,000 of that 100,000 ended up going over on your 1040 tax return under the actual taxable income because of the Schedule C. That's all I'm going to say about that because it's a separate schedule. We're going to focus on Schedule A, and I'm going to go through this. Again, bear with me because you need to understand it or you're going to miss out. So when we talk about adjusted gross income and deductions, remember AGI, you're taking your gross income and you're taking deductions like contributions to IRAs and what have you. And then you arrive at, they could be educator expenses, contributions to retirement accounts, like I said. You arrive at AGI, that's adjusted gross income. And there's a line for that you'll notice on your 1040 tax return. Now, from that, you either take itemized deductions or you take the standard deduction to arrive at taxable income. That's what you pay tax on, okay? So you don't pay tax on the full gross income. So here's, in a simple way, and you can find this on the internet, a single taxpayer in the year 2024, the standard deduction, they don't have to sit there and itemize all these things, is $13,050 because the government says, well, the average single person has about $13,050 of deductions they probably would qualify for if they were paying interest on a mortgage or making charitable contributions, or they own a home and they have property taxes. And so this is called a standard deduction. And so they're just trying to keep it simple. And so a lot of people say, well, I like simple, so they just use the standard deduction if they're single. If you're a married couple filing a joint tax return, that is double that, because there's two of you, that's $26,100. And sometimes people say, well, yeah, let's just write off the $26,100 to arrive at taxable income, because our mortgage interest and our property, it doesn't equal that. Yeah, and so that would be the smart way to go. What I'm telling you in this episode is how to create itemized deductions that will be double or triple that. And I give an example of how I've done this many, many times for higher income earners. And it's in the related episode here on the difference between marginal and effective tax brackets. Now, a married couple filing separately, then it divides it into two. It's down to the $13,050 per person. Or if you're a head of a household, it's $19,600. And so this creates the deduction to arrive at taxable income. Now, by the way, there are other little nuances here. If you're over age 65 or if you're blind, you can get another, I think in 2024, another $1,550 on top of that in a standard deduction. Okay. Now, if you make too much money, the government also gives it, and the government taketh away. They reduce or phase out what you can take as an itemized deduction, and that's where maybe AMT, alternative minimum tax, comes into play and what have you. I'll revisit that again in just a few minutes. So one of the first things on the Schedule A that most Americans can take advantage of is mortgage interest deductions. So it would behoove you to talk to your accountant, because there are rules in the Internal Revenue Code. If you borrow money to acquire a home, the amount of money that you borrowed to acquire, construct, or substantially improve that primary residence, and it also includes a secondary residence, which could be a condo, a cabin, a boat, or a motorhome, as long as it has kitchen and bathroom facilities. You can deduct the interest on a primary and secondary residence up to acquisition indebtedness. And the rules have changed through the years. You can also borrow a home equity line of credit that I'll revisit in a moment. And sometimes they limit you up to $100,000 of the acquisition indebtedness, $100,000 on top of that with home equity line. But if you borrow on a home equity line of credit to consolidate your credit cards, you can't deduct that interest. You have to borrow using the property as collateral to improve the property, okay? If you pay down that mortgage and you pay off your house and you go back in and refinance it, good luck. There's only a certain amount you would be able to deduct if you're borrowing to improve the property. And so that's why I encourage people not to ever kill their partner, Uncle Sam, in the process by paying off your mortgage the wrong way. I'll come back to that. So you have a mortgage interest deduction. Basically, the mortgage company is going to send you a 1098 form showing you the amount of interest that you paid that you can deduct. And you can deduct interest on up to $1 million of indebtedness on a primary and a secondary residence, okay? Now, another big category on Schedule A would be your property taxes. And so this includes real property and personal property. And so if you have a house and you pay real estate taxes, property taxes on it, which many states have, you can deduct that. You can also deduct property taxes on automobiles, personal property, but there's a limit. And so it's $10,000 limit on the deduction for state and local taxes, which includes the property taxes. So if you have personal property taxes on automobiles and what have you, they're different. You can still take advantage of that, but most Americans, if they own a home, that's going to use up the entire limit of up to $10,000, okay? So if you borrow on a home for a home equity line of credit on top of your first mortgage, again, you can do that, but you can only deduct the interest if you're using the proceeds of that home equity line of credit to improve the property. If you're doing it to consolidate credit cards, you can't deduct the interest. So you've got to understand that it's up to $1 million in debt, $500,000 per person if you're a married couple filing separately, okay? A total of $1 million. Each spouse doesn't get $1 million. Now, another category would be medical and dental expenses, and I've never wished anybody have so much in medical and dental expenses over and above their health insurance premiums and what health insurance pays for, or Medicare, that it's so excessive that it exceeds 7.5% of their gross income. You don't want to hope for that, but if you keep track of your records and you have medical expenses for doctor's fees, prescription drugs, long-term care premiums that exceed 7.5% of your income, then it would behoove you to itemize those. But the government pretty much believes, hey, any American, I don't care how old you are, you know, that 7.5% of your income, you ought to be able to afford on medical expenses on top of your health insurance premiums that you pay. Now, it would also include dental. So deductible dental expenses over that limit would be preventative care, cleanings, exams, x-rays, restorative treatments, including fillings, crowns, and bridges, and orthodontic services like braces or clear aligners, okay? Those qualify. Now, When we talk about the taxes that you actually pay in state income tax or local taxes and what have you, I'm from Utah, and so a few years ago, rather than paying 7% in state tax and having a deduction on our state tax return for the federal taxes, and then the federal taxes, you have a deduction for the state taxes you paid, the state of Utah just said, you know what, we're going to lower it down to 5%, and you pay 5% on all of your income, and we're not going to include the deductions and what have you. Well, still, a lot of times it would behoove you with state and local taxes that you paid during the taxable year. You can claim deductions for those. And so sales taxes and real estate taxes could be deductible based upon your situation. Again, consult a CPA or tax attorney for your particular set of circumstances, okay? When we talk about the sales and local taxes, that spells an acronym SALT. And again, you can do up to $10,000 of SALT, if you've ever heard that term. And what we're able to do in the state of Utah is we're actually able to pay SALT taxes out of an LLC or a business entity before the end of a tax year. And that's a huge advantage to us on our taxes. And Utah did that to help out Utah taxpayers. Now, so real estate taxes, usually called property taxes, okay? Those are for homeowners based on the assessed value of the property. And again, you have a limit, no more than $10,000. So to summarize, itemized deductions for taxes paid include state and local income taxes, sales taxes, and real estate taxes, okay? So check with your accountant or your tax preparer to understand if you can take advantage of that category when you're itemizing on your tax returns. Now, another big category, which is one of my favorites, especially for my clients, most of them are extremely charitable. There are many Christian who pay a tithing to their church of 10%. Many of them contribute 15, 20%, up to 50% of their income to charity. It could be the Humane Society, the Kidney Foundation, the Cancer Society. Anytime you have a legitimate charitable organization that you donate to, if it's qualified and you get the documentation, you can deduct it off of your Schedule A as a charitable contribution. Even if you donate in kind, like clothing and furniture to the Salvation Army, they can issue a receipt, but usually there's a limit, like $500 that you can deduct off of your taxes in the form of donations in kind, like clothing and used furniture. Now, when we talk about charitable contributions, you have to keep records, the name of the organization, the date of the contribution, and the amount donated. And when you do that, if it's legitimate, the nice thing about charitable contributions, you can actually donate enough to offset 20% of your annual gross income, up to 60%, no more. Now, there have been years that I have donated more than that, and so you get a carryover, okay? And so because of the adjusted gross income, then what happens is if I had a charitable contribution that I couldn't use, I can carry it over and take advantage of it in the next year and the next year. There's a special form for doing that, okay? But see, you could offset 20 to 60% of your AGI with charitable contributions. It is a huge category that, frankly, most Americans don't take advantage of. I'm really going to bring this up, but back when Mitt Romney was running, they were always criticizing him, well, look at all the money he makes. Well, if you looked at his tax return, what he was contributing 30, 40% of all of his money to charity. And they were criticizing him for his tax bracket. Well, it's because he gives back. And if you looked at that year Obama's tax return, I don't even think Obama gave 1.5% to charity on his income. And so if you're not contributing to charitable organizations and you're only contributing 1 or 2 or 3%, you're not going to think this is much of a deal. But most people who make money, they actually give back to the world in the form of charitable contribution. So don't be quick to criticize somebody who makes a lot of money until you look at, well, how much are they giving back? 30, 40, 50, 60% You look at high net worth people, Bill Gates and their foundation and what have you, whether you agree with the mission of these people's foundation, they are offsetting their income up to 60% with charitable contributions, okay? Now, there are some other miscellaneous deductions that sometimes we don't think about. One would be casualty and theft losses. I don't ever encourage you to go out and have something stolen or somebody causing arson on your house to write that off. But if that happens, you can write it off. Unreimbursed employee expenses, and that happened with the Tax Act of 2017. It expires or sunsets on December 31st of 2017. But this is where if you have certain employee expenses when you're traveling or buying your food on the road or whatever, if you did not get reimbursed for that, you can deduct it if you do it correctly. Here's a couple of other interesting ones. Gambling losses. Taxpayers can deduct their gambling losses, but only to the extent of their winnings. You gotta take the winnings off in order to arrive at that. Investment interest. If you borrow and pay interest to invest money, you can deduct that interest. And it's right there on the deductible interest portion of Schedule A. Okay? So remember that for high income earners, there are limitations. And the most common one that's been around for quite a while is AMT, Alternative Minimum Tax. It is a parallel tax system that was established for high income taxpayers so that they contribute at least a minimum amount of tax. They can't get away with writing it all off. And so there's some itemized deductions that may have limits if you have to pay the AMT. So when you're looking at itemizing, if you're a high income earner, make sure your accountant understands and say, will AMT affect me? It has affected me on my taxes several times. And so some of the most common itemized deductions that are not allowed to calculate AMT are state and local taxes, real property taxes, and certain miscellaneous deductions subject to the 2% adjusted gross income. And that's one of the reasons why I like charitable contributions, because this does not come under these bullet points right here. Okay, so let me connect the dots here. If this seemed a little bit tedious, if this seemed a little bit tedious, it's because I wanted to make sure you understood the categories on Schedule A of a 1040 tax return that you can itemize. Now, again, a lot of simpletons criticize my videos when I talk about how to become your own banker, or when my video that has had nearly 1 million views on how to get out of debt and pay off your mortgage 2.5 years faster by not giving extra principal payments to the mortgage company, because you're keeping your mortgage high. Most of my high net worth clients, they have their home and other real estate mortgaged to the hilt. Why? They have the money. They understand how money works. They understand that money that they would put up in an unnecessary down payment is not liquid. It's not safe. It's not earning a rate of return. The property is going to appreciate or depreciate regardless of whether it's mortgaged to the hilt or free and clear. They understand by preserving their money, they make money because they can borrow like banks. They borrow OPM, other people's money, because they're not just a benevolent institution paying people interest. They're borrowing that to make more interest. Would you hire an employee for $30,000 if that employee made you an extra $90,000? I'll do that all day long. That's a 3 times return. That's 300% more return on employment cost. Would you buy a widget machine for $30,000 that made you an extra $90,000? So what am I talking about? If you borrow on a mortgage, on a piece of real estate, including your home, and you borrow that money at 4.5% interest and it's tax deductible, like I've talked about, in a 33% tax bracket, that's only a net cost of 3. So on every $1 million of mortgage interest, mortgage debt, I'm paying $30,000. But that $1 million that I didn't put in there, okay, that $1 million is over in my favorite vehicle in IUL, earning 9 or 10%. How much more is 9 than 3? I'm making $90,000 tax-free, not taxable, tax-free every year on the $1 million that I didn't put into an unnecessary down payment or by paying off the house, and I'm willing to pay $30,000 a year. That's a 300% return. There's a lot of simpletons that don't understand that, or they say, well, most Americans should take the standard deduction. That's a generalization. They don't know what they don't know because they haven't understood what I'm talking about here. So many of my savvy high net worth individuals, they take advantage of the full $1 million of debt on their personal residence. They could pay it off with an electronic funds transfer or phone call by taking it out of their IUL and paying it off. But they don't do it because they would be killing their partner, Uncle Sam, tax deductible interest, by itemizing, because if they're paying 6%, that's $60,000 a year in interest they get to write off of their 1040 tax return on their itemized Schedule A, $60,000. And they contribute tithing if they make $300,000 a year. That's tithing of $30,000. And if they have $10,000 up to the limit of property, they have $100,000 of deductions. They right off the bat by itemizing, their $300,000 gross income is reduced down to $200,000. Okay, this is smart when you understand how to do this. And so don't just jump to the conclusion, oh, it's better just to take the standard deduction. Well, that tells me right off the bat, well, maybe you're not earning enough money, you're not making charitable contributions, you don't understand math, you don't understand how money works, okay? And so that's the critical point here. I've helped many, many high net worth individuals create and resurrect, if they've been killing them by paying off their properties the wrong way, resurrect tax deductions on not only Schedule A, but Schedule C, off of their Schedule E for the real estate or their LLCs or corporations that own those properties. When you can keep or create or resurrect deductions that you've been killing, watch your marginal tax bracket and your effective tax bracket go down, 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 and then you have the simpletons out there and go, well, how come they're in an 11% effective tax bracket? I make half as much as they do, and I'm in a 16 or 17% effective bracket. It's because you didn't know what you didn't know. And why savvy, smart people understand how money works and how to make these tax laws work to your advantage. The politicians understand it. They pass most of these laws for them. So if you want to learn more, watch the other episode, the difference between marginal and effective tax brackets, and I'll give you actual examples of a married couple that itemizes and a single person who doesn't. And then I would recommend that you study my book, The Laser Fund. This is a 300-page book filled with charts and graphs and explanations. It's actually 2 books in one. This side is 200 pages, 14 chapters with all the left brain charts and graphs. If you're more of a right brain learner, you learn more by stories, you flip it over to this one, about 100 pages, 12 chapters with 62 actual client stories. You can use your left brain or your right brain or use your whole brain, okay? Now, this sells on Amazon for $20 to $60 if you buy it on Amazon, thank you, but I'll gift you a copy free. Simply go to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that, but I'll pay for this book. I'll fire out a hard copy to you via priority mail. And when you're in there claiming your free copy, if you'd like to listen and learn or watch and learn, there's those formats available for your investment. You can also schedule for a free educational webinar that we teach on a regular basis. And you can even schedule an appointment to talk to an IUL professional, the top 13 out of over 5,000 I've trained, the creme de la creme. And there's no cost or obligation for doing that. Because if you want to employ these strategies, it's imperative that you do it right. And over 99% of financial planners in America do not know how to do what I talk about on this channel.